My work with Professor Bernanke is about how the real sector and financial sectors interact. And what motivated us was the Great Depression, to try and understand why there could be such a sharp and persistent decline in output. And it appears to any observer that financial conditions were critical. That is, a sharp deterioration in financial conditions contributed to the Great Depression. But existing macroeconomic frameworks at the time really were silent about this because these frameworks had perfect financial markets and you really couldn't talk about financial conditions in any meaningful way. So we developed a theory which involved introducing frictions in financial markets into macroeconomic models, and then we illustrated how there could be a mutual feedback. That is, a tightening of credit conditions could lead to a downturn in real economic activity. That could cause financial conditions to further deteriorate and feed back to the real economy and so on. And we dubbed this mechanism the financial accelerator. So how does the financial accelerator work? Well, key to the mechanism is that there's imperfections in financial markets. That is, borrowers have to pay an extra cost in order to obtain funds because of these frictions. And this extra cost they have to pay depends upon their creditworthiness, which is really reflected in the strength of their balance sheets. So the way the financial accelerator works is if there's a weakening of borrower balance sheets, say asset values fall, that's going to make credit access more difficult for them. It's going to raise this premium for external finance. When the cost of credit goes up, that's going to reduce investment demand for consumer durables and so on, and that leads to a weakening of real economic activity. Then what happens? Well, asset values and cash flows fall further, which weakens balance sheets, and that raises cost of credit, and so on. So what it kind of gives you is an adverse feedback loop between the real sector and the financial sector. Now, one question is, how does our work compare with Professor Kiyotaki and more? In my view, it's very complementary. We both have theories about the adverse feedback loop between the real and financial sector. The actual details of the feedback differ. And what we did originally was emphasize the behavior of cash flows. That is, in booms, cash flows go up. Balance sheet strengthens, that makes access to credit better, reducing credit costs, and so on. The reverse happens in downturns. And we were motivated by this evidence that links investment to cash flow. What Professors Kiyotaki and Moore focused on is movements in asset values. So when asset values go up in booms, that strengthens balance sheets. When they fall in recessions, that weakens them, and so on. And my view is that we want to integrate both of these stories. In fact, that's what Professor Bernanke and I did along with Simon Gilchrist. We developed a framework that kind of tries to synthesize both approaches. So the question is, how do financial accelerator and credit cycle theories affect the transmission of monetary policy? They are both theories about how credit conditions matter to the transmission of monetary policy. For example, when a central bank tightens monetary policy, because that will lead to a reduction in cash flows and asset prices, that's also going to tighten credit conditions and thereby have an amplified effect on the real economy. So that is, not only is there a direct effect of central bank monetary policy on interest rates, there's an additional effect on access to credit. And that additional effect will amplify the effect of monetary policy. The question is, how do these theories have relevance for the kinds of non-traditional monetary policies that the central bank undertook during the Great Recession? And let me say, or dare I say, the chairman of the Fed, who happened to be Ben Bernanke, was clearly influenced by the ideas in this work. Now, one way to think about quantitative easing, for example, is the Fed stepping in as a financial intermediary to make up for the collapse of financial intermediation that happened during the Great Recession. That is, the investment banks who were funding mortgages went under. They couldn't fund these mortgages. That led to an increase in costs. What the Fed did is step in, buy mortgage-backed securities, and funding them by issuing short-term debt. So the Fed basically acted like a financial intermediary, and that helped compress credit costs. In fact, Bernanke referred to these policies as credit easing because what was going on? Well, there was a disruption of credit markets which was affecting real economic activity, but the Fed stepped in and basically provided these missing intermediary services, facilitating the flow of credit and getting spreads back down. Okay, the question is, in light of the severe impact of COVID on the economy, what are the options for policy, especially given that interest rates have been pushed to zero? Now, first and foremost, I think the fundamental problem here is the virus. And I think dealing with the economic crisis involves dealing with the virus. Getting people vaccinated, making sure they're wearing masks, and so on. And we're definitely seeing signs of progress in the U.S., and it seems like that's the case in the Euro area as well. Now, it is true, given interest rates are at zero, and not only short-term rates, long-term rates as well, it does seem that there are limits to what monetary policy can do to further stimulate the economy. Monetary policy can guard against an unraveling of financial markets, but in terms of providing further stimulus, that's questionable. So what seems to be the case in the U.S., though, is that there is scope for fiscal policy, and this policy should be targeted towards areas hit hardest by the virus and thus the recession. And these policies also should be thought of not simply as stimulus, but also as relief. I think to finally get out of this crisis, we're going to have to deal with the virus. And that's where the first focus should be.